Retiring during a market downturn can feel terrible. After decades of diligently saving, seeing your portfolio dip just when you're about to depend on it is undeniably nerve-wracking. It's natural for soon-to-be retirees to wonder if delaying retirement until markets recover is the right move, but I'm here to explain why that shouldn't be the case. Hi, my name is Chris Kovalchuk and I'm a portfolio manager at Claret Asset Management. In today's video, we'll explore how a market downturn may affect your retirement and why you shouldn't let it derail your plans. First, it's crucial to know that a well-crafted retirement plan can withstand a bear market. Historical data and financial research shows that a market crash alone shouldn't disrupt your retirement timeline. The biggest concern when retiring into a downturn is something called sequence of returns risk. Simply put, poor investment returns at the beginning of retirement can permanently impact your portfolio because you're forced to sell assets at lower prices to cover living expenses. As one strategist put it, the order and timing of returns matters greatly in determining how long your savings will last. Retirees who face early losses typically see their portfolio shrink much faster compared to those who encounter losses later on. Even with identical starting portfolios, two retirees can experience drastically different outcomes based on early retirement market conditions. For example, retiring in a down market could deplete your portfolio after about 25 years, whereas retiring during an up market could sustain your savings for over 40 years. So how can we mitigate this risk? The good news is, prolonged market slumps spanning multiple years are relatively rare. Since the 1930s, there have only been a few instances of consecutive down years for stocks. Typically, bear markets recover within a few years. The key to safely navigating this early volatility is careful planning, ensuring you aren't forced to sell investments when prices are low. Reassessing your investment mix as you approach retirement is vital. While stocks drive long-term growth and protect against inflation, a balanced portfolio of bonds and other fixed income assets can help cushion market downturns. This balanced approach is something Claret highlighted in its Q1 2018 quarterly letter titled Living Beyond Your Savings. Another practical strategy is to create a cash buffer, or safety net for the early retirement years. Financial planners often recommend keeping 3 to 5 years worth of retirement spending in low volatility holdings, such as high-quality short-term bonds, money market funds, or GICs. Research by Charles Schwab found that historically, the average stock market downturn recovered within 3.5 years. So maintaining a 4-year cushion of safe, liquid assets usually prevents the need to sell stocks during downturns. While this advice makes sense logically, it's often challenging emotionally. Retiring into a market crash tests even the most seasoned investors. That's why emotional discipline is as crucial as financial preparedness. A market downturn isn't an ideal way to start your retirement, but it doesn't have to mean postponing your retirement plans. By anticipating challenges like sequence of returns risk and addressing them proactively, you can take control of your financial future. You've worked a lifetime. Don't let short-term market fluctuations deter you, rain or shine. Thanks for watching. For more investment tips, visit our website at claret.ca, and don't forget to subscribe below.